What are the ethical dilemmas in customer acquisition? Cost for founders. Have you ever thought about the challenges founders face when it comes to customer acquisition cost? This topic is more than just numbers. It involves important ethical considerations. Customer acquisition cost represents the total expense a company incurs to gain a new customer. This includes marketing, sales efforts, and related operational costs. For founders, especially those eager to network and invest, ethical dilemmas often arise when balancing aggressive growth strategies with responsible business practices. One major dilemma is the temptation to prioritize rapid customer acquisition at unsustainable costs. This can mislead investors and stakeholders about the true health of the business. For instance, some startups might overspend on acquiring customers without validating product-market fit. This can lead to wasted resources and potential failure. There are real-world examples where companies expanded too quickly and spent excessively per customer without sustainable returns. This ultimately harmed both investors and employees. Another ethical concern is transparency. Founders must decide how openly to share customer acquisition, cost figures, and acquisition strategies with investors and partners. If a founder overstates the efficiency of customer acquisition or hides high costs, it can damage trust and lead to poor investment decisions. Pricing strategies tied to customer acquisition cost also raise ethical questions. Founders might be tempted to use aggressive or manipulative pricing to attract customers cheaply. This includes tactics like predatory pricing or misleading promotions. While these practices may not always be illegal, they can harm competitors, distort markets, and erode consumer trust. Moreover, the methods used to acquire customers can pose ethical challenges. For example, overly intrusive marketing or exploiting consumer data without consent can boost numbers in the short term but conflict with ethical standards. Targeting vulnerable populations to reduce customer acquisition cost may seem effective but can damage brand reputation. From a practical standpoint, founders should align customer acquisition cost strategies with core values. This means maintaining honesty and transparency with investors and customers. Marketing practices should respect consumer autonomy, and the focus should be on sustainable growth that balances acquisition costs with customer lifetime value. This approach builds long-term trust and supports responsible investment decisions. It also helps avoid the pitfalls of short-sighted growth tactics. The ethical dilemmas in customer acquisition cost for founders revolve around balancing growth ambitions with transparency, fairness in pricing, respect for consumers, and truthful communication with investors and partners. Navigating these challenges is essential for building a trustworthy and sustainable business.